morning. It's great to see so many investors here tonight. My name is Paul Niven. I'm manager of the F&C Investment Trust. And picking up on, I think, Russell's conclusion, diversification, I think, is the key message, or one of the key messages, which I'm going to be outlining as part of my talk. I'm going to talk about two things broadly. One, the trust, F&C Investment Trust, the background, some recent changes. It's very widely held, one of the most popular, I think, investment trusts in the market, so I'm sure there are many shareholders in the room today. I'll talk about some recent changes, and then I'll talk a bit about how we see the world, some of the challenges and some of the opportunities. F&C is the oldest investment trust. It was launched in 1868, so we celebrated our 150th anniversary last year. We have some families that invested at launch in 1868, and their families and descendants still holders today. And £100 invested back then has grown to over £14 million today, which I think is testament to the power of compounding over a very long time period. So 8.1% compound growth over 150 years gives you £14 million. We are the longest continually listed company in the UK, and we've paid a dividend every single year since 1868. Rising dividends in each of the last 48 years. We also have a record of consistency in management. So there are 11 managers over 151 years. I am the third since 1969, so very stable backdrop in terms of the trust. And we're very widely held, as I said, over 100,000 retail investors, and our share register is overwhelmingly retail in nature. And we've got scale, around 4 billion, just under 4 billion market capitalization and net assets, which places us just outside the FTSE 100. In terms of the proposition today, we aim to provide essentially a one-stop shop for global growth assets. Our overriding objective is to deliver long-term growth in both capital and income. And I think that's very important in the sense we aren't chasing income for its own sake. We are not a high-yielding trust, 1.6% yield, but our shareholders expect real rises in dividend year on year. Our approach is investing in global equities, listed equities, and private equity. So we do take advantage of the trust structure and the closed-ended nature to invest into unlisted assets. And we have a range of focused active strategies. So coming back to the earlier point about diversification and not betting on one particular outcome, we have a range of different approaches, which we'll talk about in a moment, which enable us to weather market storms, to add returns while reducing risk, the whole principle of diversification. In terms of the outcome we look to deliver, consistency and value for money. Value for money is clearly something that everyone is focused on these days, and our charges are 0.65%. So let me say a little bit about where we've come from. I won't give you the full history lesson, but just in terms of the recent changes that we've made on the trust, and one of the reasons I think the trust has survived for that period is really the willingness to embrace and change through time. So we've become much more global in nature in recent years. In fact, the board made a strategic decision at the end of 2012 to remove a home bias, to turn into much more global product, looking for the best opportunities regardless of where they lie. Subsequently, UK equities, which stood at around a third of the portfolio assets at the beginning of 2013, have delivered around about 70%. So UK equities have done fantastically well in recent years. We've reduced our weighting in UK equities all the way down to 5 or 6% today. And global equities, where we have, or non-UK equities, where we have the bulk of our assets, have really significantly outperformed domestic equity opportunities. So around double the returns that we've seen from global as opposed to UK. Now, some of that is down to sterling weakness, clearly, but it's predominantly due to strength in the underlying overseas markets, and the US in particular, a point I'll come back to in a moment. This point about being active but diversified, we have a range of strategies, all investing directly. So I'm employed by BMO Global Asset Management. We have internal capability, but Some of our assets are actually run by third-party managers. T. Rowe Price, they run our growth portfolio. That is the largest part of the portfolio on a single basis. We've worked with them for a long time. They are easily in the top 5% of US growth managers over the last decade. And clearly that's been one of the best places that you can invest globally is into US growth. So they've been a fantastic performer. Value is run by Barrow Hanley. And then we have internal managers in Europe and Japan. Just to give one example, T. Rowe Price invested for us in Amazon in 2006 when it's trading in the 30s in terms of dollars, now trading around 1800. So we've been quite early investors in some of our larger holdings today and certainly disruptive tech. But we don't place the entirety of our portfolio on that particular area of the market. We also have some global strategies. So we have an income strategy to help to manage the revenue account, moving from a UK to a global portfolio, did reduce the underlying yield. And we have global smaller companies exposure as well. Within BMO, some of you might be familiar with the F&C or BMO Global Smaller Companies Trust, an £800 million trust. We don't buy that trust, but that team run money for us as part of the portfolio. And then finally, in terms of illiquid assets, we've got a very long history of investment in private equity. We invested in Fleming's Bank back in the 1940s, made a couple £100 million when it was sold to Chase Manhattan back in 1999-2000. And we redeployed that capital into unlisted limited partnerships run by Pantheon and HarbourVest. That money there, which is now only 3%, is that exposure is in rundown. So we're getting a lot of cash back. And we're making new direct commitments, new primary funds, secondary funds, and co-investment opportunities. Just in a bit more detail, the private equity weighting you can see here. We've been recommitting, so the light blue lines, which you can see on the graph, represent new commitments, and our legacy holdings are going down. They'll head down to zero. We aim to have between 5 to 15% of the portfolio invested in private equity. This is an area where we've enjoyed great success. We've demonstrated very strong excess returns on private over public exposure. Again, invested in some great companies very early on, like Facebook in 2005, 380 times our money from that particular investment before it listed. So we think it provides access to some great opportunities, but again, not just in the disruptive tech space. In terms of borrowing, as a trust, we take full advantage of illiquidity, of the gearing structure, and we've seen borrowing costs decline very materially in recent years. I had this conversation 5 or 6 years ago. We'd be looking at average borrowing costs of about 7%. Our blended average borrowing cost is now 2.5%. It's not reflected on this chart, but we've got very diversified set of borrowings which extend out to 40 years. So that basically reduces refinancing risk. If you're investing long term, you don't want to have a liquidity mismatch and be beholden to the bank in terms of setting investment policy. So we've got a very diversified set of borrowings and very low interest rates on those borrowings. The advantage of that is essentially it creates a hurdle rate. If we think, for example, we borrowed under 2.7% on a 40-year basis, if we make an excess return above 2.7% on our assets, that will add value for our shareholders. I mentioned already dividends and the importance of dividends for shareholders. This gives a shorter term perspective in terms of growth in dividends, including the first half of this year. We focus on total return, as I said, balancing income needs against capital. Our revenue, which is the light blue line there, covers our dividend, and we've got 2 years' worth of dividends held in reserve. What that means is, if there's a downturn in terms of the markets and economy and our income account suffers, it means we're in a fantastic position to weather that downturn and continue to pay rising real dividends to shareholders. So what does it all mean in performance terms before I get onto markets? Well, I took over the trust mid-2014. I could have chosen any variety of dates, but I'll take the point when I actually took charge of the trust, so 5.5 years ago almost. The IA median, that bar I've just put up, represents the average open-ended fund from a global equity perspective. So if you buy a retail open-ended product, that is the median return that you would have achieved. 70%, pretty good, I think. That's a passive return from the Vanguard ETF. So unfortunately, it's not a great advertisement for active management. Passive has materially outperformed that open-ended median in the global equity space. The index, a gross index, gross of withholding tax, but that's actually beat the passive product. Our return, last two bars, our net asset value return is shown second from the right, and our share price total return is shown lastly. So we've more than doubled our money, our shareholders' money, since mid-2014, and we've exceeded all comparators, including the median returns from the global growth sector within the investment trust space. So exceeding passive, active closed-ended, open-ended, as well as index returns. We've also benefited from a material re-rating. What that means is this discount, which stood around 10% pre-2014, has narrowed such that we reached a premium last year and earlier this year. We got to the point of issuing shares. As it stands today, we're trading around a 2.5% discount. Look-through exposure, when you take all those components of the portfolio that I mentioned in terms of underlying strategies who are investing directly into securities, this is what the portfolio looks like geographically. So the largest single area that we invest is in North America and the US. We've got only a little bit in Canada, actually. The UK, as I said, including private equity, is only around 6% today. And then we're relatively diversified from a sectoral perspective as well, not taking particularly large positions against a global benchmark. Let me move on, just in the interest of time, to the market. And I think, reflecting some of the points that Russ was making, a year ago, rates were being raised by the US Federal Reserve. People were concerned about the outlook. Obviously, equity markets fell very sharply in December. And those fears that people had about recession, fortunately, did not manifest themselves. And actually, it's been a great year for investment in risk assets, and most assets, actually, but equities in particular. We're delivering returns of about 20% or thereabouts year to date. But thinking about some of the key market issues, I think it's a critical question if one looks over the next 12 or 18 months, whether we're close or how close we are to the end of the cycle. I think we're clearly closer to the end than the beginning. This is the longest cycle in history. But how soon a US recession unfolds. Now, that might sound somewhat abstract. Why does it matter? It really matters because you need a US recession or a global recession to drive down earnings and likely to lead to the next bear market, unless you're a big valuation bear, which is a point of discussion that we can have. So a call on the macro perspective, I think, is important. Secondly, US outperformance. I showed you earlier on that global equities have very materially outstripped returns from the UK and, in fact, most other regions. How long can that continue? A lot of that is related to the growth value call, actually. And value has clearly been a laggard over the last decade or more. Growth and quality have been in the ascendancy in terms of styles for investment. And finally, we've only got a small portion in UK assets, but actually when you're investing overseas, sterling is quite a considerable risk in terms of moves on sterling can impact your overall total returns from a shareholder's perspective. So again, I'll maybe just touch on that if I have time. So this chart just shows you that if you were worried about recession over the summer, you were not alone. There's different ways of thinking about concerns over recession. You can look at market indicators. This indicator is actually Google and how often people were Googling US recession. And what's interesting is that this is the peak, which was pre-global financial crisis. And during the summer, we actually had almost as much concern about US recession as we did in 2008. Now, as always, you can read charts one of two ways, and you could say, well, actually, people got rather complacent, rather like here, perhaps, and then subsequently, financial crisis came along. I'll let you to form your own conclusions. But what was interesting is that at this point here, at the peak of recessionary concerns, bond yields were on the lows, hitting new lows in the UK and elsewhere. Value was also on the floor, and people were really concerned about the overall economic outlook. What's happened in the last couple of months has been quite a rotation, actually, within the market from growth to some extent to value, and we're seeing some straws in the wind that might precede a change in terms of styles. Now, why was the market concerned? It was partly, well, two primary reasons, I would say. One, yield curve inversion. That means that long-term interest rates were below short-term interest rates. What was unusual was the Fed was cutting short-term rates, and yet long rates were falling faster. That's a good precursor to recession. Normally doesn't fail. There's a question about what the lead time is, but it's a pretty good indicator of recession. The trade war, we're only ever one tweet away from, another escalation in trade tensions. Also of concern, falling profit share. Profits are very, very high compared to history in the US and globally. It's begun to come off. Margins are coming down. That's of concern. And frankly, the global economy is very fragile. So low trend growth rates globally mean that we're always on the cusp of about to, it's like, riding a child riding without stabilizers. They're almost just about to fall over. And this is the second time since the financial crisis that global interest rates exceeded 1%. And each time, central banks have had to rein back tightening and actually cut rates. What that tells you is the global economy can't actually bear much higher interest rates. But I think there's a lot of positives still. The housing market in the US remains robust. The labour market is in very, very good health. Inflation remains low, and frankly, there's very, very little sign of an upturn in inflation. In fact, if anything, wage inflation is beginning to recede in the US, and the Fed is accommodative. So overall, I think the picture is actually reasonably constructive. And actually, the blue line here reflects global manufacturing data. That's where the concern was. That's not where the bulk of economic activity takes place, but it's where most of the volatility arises. And again, a few straws in the wind. The red line just shows orders to inventories. So basically, manufacturing orders are rising relative to inventories, and that tends to lead economic activity. So it's early days, but markets, again reflecting the earlier comments, are feeling better about the growth picture. And also the US consumer remains very robust. This is US real retail sales. There's no sign of a downturn. So picture looks reasonable in terms of the global growth picture. I want to just make a few comments about what I personally think is a hugely important, but also a very big topic. So I'll try and be brief. But I think it actually impacts on the economics, the markets, and the politics. But what we can observe is stagnant productivity, very low levels of productivity in developed markets, very high levels of profit, low levels of labor share. So capital is winning at the expense of labor. Businesses are taking bigger share than labor. Very low levels of investment by the corporate sector. High levels of inequality in society, the billionaires, and falling dynamism. So businesses in the US are aging. There's less entrepreneurship. There's less business startups. Now, why do we see this? I think there's a couple of interrelated reasons which are increasingly being recognized by academics, by policymakers, importantly. One, rise in market power. Basically, in almost every sector of the economy, there's less competition. The larger companies are taking a larger share of revenue and also of employment. And that's also leading to rising barriers to entry. Regulation in the financial services sector is leading to consolidation. You think about oligopolistic positions in any number of industries. What that means is there's low levels of competition. Business continues to win at the expense of labor. Profits remain high. The next downturn, when the next downturn comes, it probably consolidates the position of winners, actually. And this regulatory issue, which we'll see the US election, perhaps that being quite a big theme with Elizabeth Warren, if she is the Democratic candidate, that is related to the rise of populism and a backlash against some of these trends. And it's not just about technology. That's my key point. You see it in almost every sector of the market. And these are secular trends. And they have led to some outcomes like this, which is return on equity over the last 30-odd years. In the US market, average company, top quartile, which is obviously better in terms of profitability, return on equity, and the gap is widened. But you look at the top 10% and the top 5%, it's super normal profitability for a small number of companies. The winners are taking a larger share of the pie, becoming more profitable. And frankly, from a secular perspective, this does not look like it's going to be changing anytime soon. Very briefly, market leadership. Here's a disconnect. US equities done fantastically well. Blue line is the price relative of US against the rest of the world. The orange line there is the earnings. There's a gap, so the US is outstripping its superior earnings growth. We think about growth against value, the macro picture, the bond yields. Blue line going up shows falling bond yields. That's been very supportive of growth against value, because when growth is scarce, it gets bid up. That's been supportive for that trade. But similarly, you can see the premium you're paying for global growth against global value is moved to extended levels. Again, timing these factors is quite difficult, but it is suggestive that perhaps we're reaching a point whereby certainly you should be more balanced in your portfolio allocation and diversified than perhaps you would have been up to this point, where it's all really been about the fangs and disruptive tech. Couple of final points. UK equities have been a serial underperformer. From a global perspective, it's all about sterling. That's the blue line is the year-on-year relative return against global equities. The orange line is the year-on-year move in sterling. So from a global perspective, if you're bullish on sterling, and that's implied by a conservative win, it's not actually great news for large cap UK stocks. Not surprising when you consider how much of their revenue is actually derived from overseas. But domestics, again, we might hear more about this later on. Domestics perhaps look more interesting. The blue line is the performance of a domestic basket of UK equities, which look pretty cheap against consumer confidence. So again, fiscal expenditure, Brexit resolution, good or bad, maybe that gives a bit of boost to consumer confidence. So I'll leave you with conclusions, but perhaps just to echo the earlier point, while we retain optimism, I think at this stage of the cycle, we're late, we think there's more to go for, but diversification makes sense. Thank you.